All right, friends, a very good evening, and I hope you're doing well. I am excited to talk about the different concepts of consolidation regarding which we receive questions from all across India. And let me get started with just a quick brief intro, and then I will go a deep dive into different points of consolidation. Firstly, I found that approximately 80% of the students who take CA examinations have some fear about consolidation. I want to tell you something. There is no other topic in your entire CA curriculum which is more interesting than consolidation. Now, the reason why it looks slightly scary for some people is it's actually so conceptual, you can't by heart it. You can probably by heart some other topics, unfortunately, but you can't by heart consolidation at all. So that is what makes this consolidation subject, a thing which is a nightmare for those who want by heart, and it always remains a darling topic for those who want to learn it conceptually. And we know that we get a sure shot 16 marks question from consolidation. And how do we approach this? Friends, I will talk about the doubts which specifically some of our students started shooting over the past few days. And if you have any doubts, you can send those doubts across on the Facebook link or on the YouTube link. If you think this session will be of importance to any other friend of yours who is pursuing CA, please feel free to share it and do it as quickly as possible so that even they will be benefited from this. All right. Let me get started with the first question. The first question is from Deepa Shah from Ahmedabad. Deepa's question is regarding, sir, how should we deal with time adjustment in consolidation? Deepa, so when you talk about time adjustment, understand the principle. When will time adjustment be required? If we have the subsidiary company's balance sheet on the date of consolidation, meaning, I repeat, Deepa, if we have the balance sheet of subsidiary company or the profit position of subsidiary company on the date on which holding company acquired shares in subsidiary. For example, holding company purchased the shares of subsidiary on 1st of August 2018, say. On this day, if you have the position of profits of subsidiary company, means reserves position, if you have, then you are set. You don't need to do any time adjustment. Why? You exactly have on the date when holding company purchased shares of subsidiary, what is the position of profits? All the profits which existed till that date will be considered as pre-acquisition, and all the profits after that date will be considered post-acquisition. So essentially, you don't have to worry about any time adjustment when such profit is available in the question. But when will time adjustment be important? If the profit position, reserves position of subsidiary is not given to you in the question with respect to the date on which holding company purchased shares of subsidiary, that is when the problem starts. So then what should you do? You will have to ensure that you do time adjustment. When you are doing time adjustment, remember there is an important assumption you are making. What is the assumption you are making? Say, I don't know what is the profit for, say, the first 5 months, and the date of acquisition is, say, at the end of 5 months. So first 5 months should go into pre-acquisition, next 7 months should go into post-acquisition. I don't have clarity on exactly what the first 5 months profit position is. Then how will you deal with it, friends? The first 5 months profit position, if you don't have exact number, you will have to consider that profit is earned evenly over the period. Evenly over the period means you will assume that over the entire 1 year, the company earned profits equally, every month equal profit. So then you will say, oh, for 12 months, for example, 12 lakhs is the annual profit in the 12 months. Then you will say, oh, for 12 months, 12 lakhs is the profit. It means for 5 months, out of that, 5 lakhs is the profit. So like that, you will do the time adjustment. So friends, time adjustment is basically an approximation what you are using, Deepa. Yeah, Deepa. So ensure that you do this time adjustment only when the actual position of profit is not given. And I remember, I'm just consolidating the doubts and I'm clarifying it. So one student asked me, sir, why can't we do time adjustment even when the position of profit is given in the question on the date of acquisition? See, when you do approximation, You will do approximation when the actual is not known. If the actual profit position when holding company purchase shares and subsidiaries given to the problem, why should you do any approximation? You have actual, you should take actual, right? Why did you do approximation? Okay, so I hope Deepa this answers your question. Right, so then there is another question which we got from Krinal from Ujjain. Krinal's question is, sir, sometimes in abnormal items we add back, sometimes we deduct. When should we add back? When should we deduct? So, Krinal, understand first, what is our problem with abnormal items? Why do we talk about adding, deducting? What is the main problem with abnormal items? Listen, friends, if you talk about abnormal items, basically they don't occur over the period. They are one-time events. They don't occur over the period. They are not recurring in nature. So when they are not recurring in nature, the problem with these abnormal items is you can't say, just sometime when we're talking about when you do time adjustment, you will assume that the entire profit is earned evenly over the period, and 5 by 12 of that profit we considered in first 5 months, and 7 by 12, that is 7 lakhs, we considered in the next 7 months. So this kind of adjustment, what we do is assuming that the profit position is even, or the profit is earned evenly over the period. But please understand, Krinal, if you have any abnormal items, I can't say if in July of that year we earn suddenly some 10 lakh rupees of abnormal income. We don't expect to earn some income like this. Maybe our land was being taken away by government, and for that we received a compensation. We received 10 lakh rupees as compensation. So that kind of income is not expected to occur every year. If it is not expected to occur every year, then you cannot say that, hey, this income I will consider as earned evenly over the period. So the reason why you add back or deduct abnormal item, first of all, is that profit, whenever you have to distribute that profit over the financial year and say this portion is pre and this portion is post, that splitting, before you do that splitting, you will have to remove the impact of any abnormal item. So for example, if say the profit is 12 lakh rupees, in that 12 lakh rupees, say 2 lakh rupees is the abnormal item, abnormal loss. Let us say 2 lakh rupees is the abnormal loss. What would have happened? 12 lakh rupees is the gain, is the profit for the period. To arrive at 12 lakh rupees, this 2 lakh rupees would have already been debited to P&L. So that essentially means that your profit before deducting this abnormal loss would have been 14 lakhs. So that 14 lakhs is the profit, we can say, is the normal profit. Normal profit means that profit is something which we can say we will earn over the period. So normal profit I'm repeating is the profit which we can say we will earn over the period. But abnormal item is not something which we will earn over the period. It is just over one time issue. So with abnormal items, what you do is that abnormal event. So first we neutralize. What do you mean by neutralizing the impact? Nullifying the impact of abnormal item. 12 lakhs was the profit after all adjustments. Then abnormal loss of 2 lakhs was reduced earlier. Now when I add back, what will happen? That is becoming 12 plus 2, 14 lakhs. So 14 lakhs is the normal profit. Normal profit is expected to be earned evenly over the period. There we can do time adjustment. 5 months, 7 months, like that we can do time adjustment. We can split that. And then after time adjustment, what you do is abnormal loss you have. That abnormal loss actually is a loss that the company suffered. That you will reduce. Reduce from which period? You will reduce from the exact period in which that event has occurred. Imagine this abnormal loss of 2 lakhs happened in the pre-acquisition period. Then what will you do? You will deduct it only from pre-acquisition column. So in our consolidation learning, we have that beautiful analysis of profit table where we understand how to write this pre-acquisition, how to write post-acquisition, everything we understood, right? So what you should do is you will have to split this properly, and the component of abnormal loss what you have, you will subtract it from pre-acquisition or post-acquisition as the case may be, based on the actual date when that event has occurred. So the abnormal loss is falling into post-acquisition period, you will deduct it from post-acquisition period. If it is from pre-acquisition, you will deduct it from pre-acquisition. So it depends on the actual date when the abnormal loss has occurred. So Krunal, I hope it answered your question. If there is further something that you have as a doubt, feel free to ask. Right. Then let me take the next question. The next question is from Vivek Bhatt, Bangalore. So Vivek's question is, sir, why do we deduct preference dividend even when the company has not allocated, or basically I understand that as the question, I think what he's talking about is, even if the company has not declared preference dividend, why do we deduct preference dividend is the question. Krunal, Vivek, there is a very important point you need to understand. When our Indian accounting standards were being created, the base for these accounting standards were the international standards. We took the international standards and based on that we created the Indian accounting standards. When we did that, I think, okay, so my best understanding of this is mostly they would have copied one paragraph, which is our paragraph 27 of Indian accounting standard of our accounting standards. This paragraph, if you read in the light of our Indian Companies Act, you will feel that that paragraph 27 makes no sense. I understand why you got that doubt also. Because if you read that particular paragraph 27 of Consolidation, Accounting Standard AS 21, you will feel it makes no sense. What is this nonsense? How can you say preference dividend should be deducted even if it is not declared by the company? Okay, why do you do that? There is a logic to it, very important logic to it. Please understand. Internationally, preference shares, even though we call them as part of share capital, you have to clearly identify, is it something which is leaning more towards equity or is it leaning more towards debt or liability? I'm repeating. You will have to clearly identify, are these preference shares leaning more towards equity side or are these leaning more towards debt side? And a lot of times these preference shares lean more towards debt side. So unless they are irredeemable preference shares, which anyway are not permitted in India, these have to lean more towards debt side. See, forget the tax implication, forget, oh, this is above the line adjustment, below the line adjustment, leave alone those technicalities. These preference shares basically are, you know that there is a fixed rate of dividend and the company generally has to pay that preference dividend unless the company doesn't have profit or unless the company has profit and it doesn't want to declare preference dividend. Company generally pays that preference dividend. So considering that this preference dividend is more in the nature of a liability, people across the world feel that preference dividend is more in the nature of a liability than it being more in the nature of capital or more in the nature of kind of distribution of profits. So because it's considered more in the nature of a liability, what happens is this preference dividend, if there is preference share capital in the subsidiary company, if there is preference share capital in the subsidiary company, in the analysis of profit what we make, we have to compulsorily deduct the preference dividend because in the financial statements of the subsidiary company, preference dividend wouldn't have been deducted if that was not declared by the company. But even if it was not deducted, what will you do with liability? With liability, will you say, I didn't declare or I didn't decide whether to pay interest or not, I will not account for interest. Can you say that? No, you can't say that, right? Same logic you apply even for preference share capital and preference dividend of a subsidiary company. You can't say, I didn't decide whether I have to pay preference dividend or not. You can't say that if you treat preference share capital more in the nature of a liability. That is why our friend Vivek got this doubt as to why we are considering preference dividend as a deduction, even if it is not in the question. Friends, it is one of the traps. When you read the question of consolidation, if you see that the subsidiary company has any preference share capital, trust me, that is one area where most of the students will make a mistake. What is the mistake? They will forget it. Why will they forget to account for it? They will forget to account for it because the examination question will not specifically ask you, please deduct preference dividend. It will simply say, I gave preference dividend. You have to read paragraph 27 of accounting standard 21 and paragraph 27 clearly says there is no need for the subsidiary company to clearly declare the preference dividend. Even if it is not declared, you have to consider that and you have to deduct it while calculating analysis of profit. So Vivek, this is the point. And look from this perspective, look at that question and try solving it. If you have a doubt, please write back to us. Okay, so now let me go to the next question. This question is from Sirisha in Vizag. Okay. I think we are getting some more questions. Like Sirisha, I'll take your question in a moment. So we are getting some questions like Meena Bijayan is asking this question. Sir, need clarification regarding holding on debentures. Okay. So Meena, listen. If holding company has debentures of subsidiary company, if holding company has debentures of subsidiary company, let's just think about it from a consolidation perspective. I'm the holding company, say there's a subsidiary company. If I am holding the investments in I'm holding the debentures in subsidiary company, in holding company's standalone balance sheet, how will you have it? You will have it as investments. And in subsidiary company, it will be sitting in the debentures. Correct or not? So basically here you have investments and there you have correspondingly the debenture liability. Now, if the holding company purchased the debentures of subsidiary company at par value, means the debentures in the subsidiary company in its balance sheet liability will be stated at par value only. If that is at par value, even that is purchased at par value by the holding company, then there is absolutely no confusion. Simply what you should do is at consolidation level, you will reduce this investment. Whatever, say for example, 10 lakhs of investment holding company made, you will reduce this investment, or you will reduce investment, and correspondingly you will reduce the debenture liability. 10 lakhs reduced here, 10 lakhs reduced there, done. That's all. So out of the total debentures in subsidiary, maybe 15 lakhs of debentures are there in subsidiary. Out of 15 lakhs of debentures in subsidiary, say 10 lakhs are held by the holding company. These 10 lakhs held by holding company at consolidation level will get reduced from the at a consolidation will get reduced from the investments, and correspondingly they will get reduced from the liability. That is straightforward. But the challenge, Meena, you will have when the debentures liability is at say 15 lakh rupees. For example, all the debentures of subsidiary are purchased by holding company. All 15 lakhs of debentures. But holding company paid 16 lakh rupees. Holding company paid 16 lakh rupees to purchase those debentures which were shown in the subsidiary company at 15 lakhs. I'm repeating. Subsidiary has liability at 15 lakhs. Holding company purchased those debentures from market at some 16 lakh rupees. Then what will happen? There is an extra amount of 1 lakh rupees which the holding company paid to purchase those debentures. Do you understand this point? So now come to consolidation. When you come to consolidation, at a consolidated level, there is an asset which is standing at 16 lakhs. There is a corresponding liability which is standing at 15 lakhs. Now, how do I cancel this? I need to cancel this 16 lakhs and 15 lakhs. So 15 will go. That is straightforward. But please understand, the way you have to look at it is, in order to pay off a liability of 15 lakhs, it is as if you spent 16 lakhs. I'm repeating, as if to pay off a liability of 15 lakhs, you spent 16 lakhs. So that extra 1 lakh is like a loss. Loss for whom? It is a loss, or it's a burden which the holding company incurred. If it is a burden which the holding company incurred, then how do we account for it? So now out of this 15 lakhs and 16 lakhs, I said 15 and 16 are 15 will go. That 1 lakh it still remains in the asset, should be gone. So if it should be gone, correspondingly, profit and loss account of the holding company should be reduced. I'm repeating, profit and loss account of the holding company should be reduced to the extent of 1 lakh. That is the treatment what you should give. Meena Vijayan, I hope your doubt is clarified. Okay, right. So if you have any further doubts, please keep asking. So let me go to Sirisha's doubt. So Sirisha's doubt is, sir, if there are bonus shares, then how do you consider the holding ratio? Sirisha, it's a very simple point. I explained this in a great detail in my videos. What you should do is, Sirisha, there is one very important point, or one clear area where people make mistake. That is, when there is any bonus share, you have to calculate the holding ratio. When you have to calculate the holding ratio of what holding company has in subsidiary, how do you mean by holding ratio? In subsidiary, there are 100 shares. and holding company has say 80 shares out of those 100 shares, then you will say 80 out of 100, 80% is what holding company has in subsidiary. That is what you would say. Now, that 80 and 100 should either be before bonus or after bonus. Now, why am I saying this? If you say that 80 out of 100 means 80% is the holding ratio, then you should ensure that if numerator is before bonus issue, denominator also should be before bonus issue. If numerator is after bonus issue, denominator also should be after bonus issue. Now, one of the common mistakes that students make is they may consider numerator after bonus, denominator before bonus, or other way around. That is when your holding ratio will go for a toss. So your question is regarding how you have to calculate the holding ratio when there is bonus. So Sirisha, just bear in mind, you have to make sure that the holding, the numerator as well as denominator are either pre-bonus or post-bonus. Now, why am I saying they can either be pre-bonus or post-bonus? See, bonus issue will not change the holding ratio. That is one important point you have to bear in mind. Say if today in the subsidiary company there are 100 shares and there is a bonus issue of 1:1. There is a bonus issue of 1:1. Then what will happen? If there are 100 shares, 100 more shares will come up. Now, if I am holding currently 80% of, I am holding company, I am holding currently 80% of shares in the subsidiary. Means I am holding 80% of what? I am holding 80% of 100 say currently. If I am holding 80% of 100, 80 shares I am holding. After bonus, how many shares will I have? 1:1. I will have 160 shares. Do you understand that? So it's not just me. Bonus cannot be selective. The important point here is, as per Companies Act, bonus can't be selective. I can't say for this category of shareholders I will give bonus, for this category I will not give bonus. It doesn't work that way. So friends, the important point is, because bonus cannot be selected as per Companies Act, you can take the holding ratio when bonus is there, either pre-bonus or post-bonus. That should not change. That will not change the holding percentage. Right. Then I have some more questions here, but Deep Gupta asked a question. Sir, whether marks are deducted for not presenting consolidated reserves and surplus as per Schedule 3 in notes to accounts? Good question, Deep. Okay. So, how are you expected to present your consolidation notes and consolidation reserves? As I understand your question, mostly what you are used to doing is you are used to writing consolidated notes as more like a working note, and you just, I mean, I think that's what I'm guessing. So maybe you are used to giving that consolidated note, a working note number, say working note 4 or working note 5. That working note number maybe you are used to giving in the balance sheet. So your question is, sir, is that okay, or should we present it as per Schedule 3? Now, I will give you a small tip. You can solve your, I think he confirmed that I understood his question correctly. So, Deep, what you can do is, you make your answer, that schedule, that working note, what you want to make. That working note, don't call it working note. What you want to make is working note, I understand that. But don't call it working note. Basically, you are explaining the consolidated reserves and consolidated P&L, right? So just call it that you give space below your balance sheet for that note on reserves, consolidated reserves. And whatever you would have written in the working note, just write it here, that's all. So you don't have to repeat that. And don't worry, even if your note is not exactly in the form of, oh, what is opening, what is a change, what is closing. I understand. So, a lot of times, given that we have consolidation question for 16 marks, and 16 marks means how much time can we give? 16 into 1.5, maybe about 24 minutes to 30 minutes maximum we have for solving the question of consolidation. We can't really present notes to accounts in the most ideal manner. We love to do much more, but we don't have time enough. So that is why ensure that detail in what you are preparing, you just give it below the balance sheet as a part of notes. And don't call it working note, just include it in the regular notes only. That much you do, at least I'm reasonably sure that examiners will be happy that you have expressed your knowledge by discussing this in the part of as a part of notes. Deep, I hope it answers your question. Okay, right. So there is one more question which we have from Jaspreet Singh. Jaspreet, Jaspreet's question is, sir, what shall be the treatment of proposed dividend since ICI still included them in the balance sheet? Jaspreet, I know from what level of confusion this question comes, because it's not just you. There are hundreds and thousands and lakhs of students who have this doubt. Why do we still have it? It's unfortunate. What is that we should have done? We should not show that adjustment in the balance sheet. That is the reality. But do we have it in the examination problems? Do we still have it as an item included in the balance sheet? Unfortunately, even in the recent examinations, we still have that shown in the financial statements. So we still find that accounted in the financial statements. So my suggestion to you, Jaspreet, is for the purpose of consolidation. I feel heavy in my heart to say this, but for the purpose of consolidation, continue to follow what institute is doing in the study material practice manual, but in your real life, please be clear, you should not account for proposed dividend. So regarding proposed dividend, we know if it is for current year, you shouldn't account it in the current year. In the real life, I'm talking about, and you should treat it or you should account for it only in the only when it is actually declared in the AGM. So you should not just account for it at a proposed level. Okay. So Jaspreet, I hope it answers your question. And let me go to next question. So this is Ritvik Baror. His question is, sir, please can you give guidance about amalgamation intrinsic value full-fledged sum? Okay. So Ritvik, I have to be fair to this particular session. This session is exclusively on consolidation. So Ritvik, there are videos on amalgamation, how to calculate intrinsic value, etc., which we have in our modules, and our team will help you find that particular problem. I hope that's fine with you. Okay. So again, there is one more question from Vijay. Question is, sir, clarify in adjustments regarding different reporting dates for holding and subsidiary company. Yeah, I think just before the start of the session, she sent that question. So, Meena, let me discuss that point with you. So the question is this: there is, say, a company. There is a holding company. Holding company's financial year ends on 31st March 2018. There is a subsidiary. Subsidiary company's balance sheet or financial year ending is 31st December 2017. So what is the confusion here? Holding company's financial year ends on 31st March 2018. So 31st March is the financial year ending for holding company. 31st December is the financial year ending for the subsidiary company. So in such cases, what are the principles that you have to bear in mind? So Meena, let me discuss the principles with you. Problem we can solve that based on these principles. So the principles are these. Whenever you talk about consolidation, you have to get the financial statements of the subsidiary company updated to the date when the holding company is preparing the financial statements, or basically the date of consolidation, because date of consolidation will always be the date when, generally will be the date when holding company closes its accounts. So holding company is closing its accounts on 31st March. So even though subsidiary company is closing its accounts on 31st December, that needs to be updated to 31st March. So what do you mean by updating? Listen, updating means in the question you will have adjustments like this. Between December to March, you will have adjustments like the subsidiary company's stock got lost in fire. Fine. If you prepare a stock account for subsidiary company, opening stock for the 3 months period is the closing stock of subsidiary stock as on 31st December. So that you will take as the opening stock on 1st January. Based on that, some stock is lost, something is purchased. So based on that, you will arrive at the closing balance, right? So even in our CA Inter, we have this stock as CA Inter, and even now in part of foundation, we have these some portions on rectifications. So in rectifications, we learn about it, and even in incomplete accounts chapter, so we talk about how these adjustments are supposed to be done. So based on those principles, you need to update these adjustments. Now, what if, say, for fixed assets, there is no further adjustment that is provided to you? If there is no further adjustment provided to you, If there is depreciation rate given to you, update for 3 months by providing 3 months depreciation. If that is also not given to you, then what should I do, sir? Then simply whatever is the number that you have in the balance sheet of December, same number you will write in the balance sheet for March, and you will write a note in the bracket saying depreciation is not provided as information is not given, which is absolutely acceptable. Then something like current assets, some debtors, or some other closing position of current liabilities is given in the December balance sheet, and you don't have the number exactly for March balance sheet. You can write a note assuming that current assets, current liability position hasn't changed. Assume that it hasn't changed. If there is some stock loss, that stock loss adjustment you are supposed to do. So by doing this adjustment, basically you have to update the balance sheet of subsidiary company and in rough work. So I'm repeating, you don't have to do it in Schedule 3 because updation of balance sheet is not a part of your main solution. Updation of balance sheet is a part of your working note. So update that balance sheet, and you can simply draw a T-shape because it is just working note. And T-shape balance sheet you draw, quickly update it, and that updated balance sheet of subsidiary as of 31st March and the balance sheet of holding company as of 31st March, you will take, and then you will apply the principles of consolidation. So Vijayan, I hope this answers your question, or at least gives you an idea as to how you have to approach this question. Okay, so we have one question from Sai Kumar. Sir, what to do for profit included in stock, whether it should be added to goodwill or not? Okay, so basically Sai Kumar, I think there is one other person who asked a similar question. Who was that? Nizamuddin from Kashmir also asked a very similar question. So let me club these two and answer for Nizamuddin as well as Sai Kumar. See, the question is this. It's about unrealized profit in closing stock. I hope that is what you're talking about. Unrealized profit in closing stock. So what is the treatment for unrealized profit in closing stock? Please understand. What is the logic? First, let's go to the logic. Then accounting treatment should follow. So there is holding company's balance sheet. Then there is subsidiary company's balance sheet. Unrealized profit means one company sold to the other company. Let us for a moment assume that holding company sold to subsidiary company. If holding company sold to subsidiary company, who would have made profit? Holding company would have made profit. Seller makes profit, right? So holding company made profit. Cost of those goods was 100. Holding company added a profit of 20% on cost. So 20% got added to it, and at 120 rupees, it was sold by holding company to subsidiary. Wonderful. Now, subsidiary company purchased it. Imagine, at this point, are we treating both the companies as separate entities, or are we considering them as one entity? We are considering them as separate entities. That is why I am saying a holding company sold to subsidiary company. Okay, so we are treating them as separate companies. What is consolidation? Consolidation is basically, if I want to put it in a very flowery language, I will say consolidation is like a dream, as if both the companies have come together. Actually, they are not come together. Actually, they are separate companies only. But consolidation is a dream, as if both are one. And how will the financial statements look like? Now, if both are one entity, imagine from this pocket I move 100 rupees stock into this pocket. I can't say I moved 100 rupees stock from this pocket to this pocket and I made a profit of 20 rupees. That sounds ridiculous, right? Same logic applies even in consolidation. So what we are trying to say is, if stock is transferred by holding company to subsidiary company at 120, there is a profit of 20 rupees earned by the holding company. The problem is if that stock is not yet sold by the subsidiary company. See, if subsidiary company is sold off that, then no problem, because it is sold means what? Risk and reward was transferred by subsidiary company to somebody else, to outside a third party. So it really went out. So that profit, what holding company earned, that profit at consolidated level, you will say, it is not I selling to you. We, it is not I, you, it is we. We sold. We sold. We sold to whom? We sold to outsider. So when we sell to outsider, then we can book that profit. So then there is no problem. The problem, what our friend Sai Kumar is talking about, and also what Nizamuddin are talking about, is when the stock is not yet sold by the subsidiary company. It is still lying in the stock of subsidiary. Imagine now both these companies became one. When both these companies became one, holding company looks at that stock and says, "Hey, I sold this to you, right? So it's still lying here. So it is still lying in the closing stock of subsidiary company." Then what should be done at a consolidation level? Now imagine you don't do anything. What will happen? Let us just think from that perspective. You don't do anything. What will happen? At a consolidation level, that profit of 20 already went into standalone profits of holding company. Because it already went into standalone profits of holding company's profit position will be more. Means that impact will be seen in the reserves and surplus. Reserves and surplus will be more, and correspondingly, what will happen? Correspondingly, the stock of subsidiary company also will be more by 20 rupees. That's the point. So that profit, unrealized profit, will be lying in the stock account, will be lying even in the reserves account. Then what should be done? We have to reduce from stock, and correspondingly we should reduce that from reserves. We have to reduce from stock means we are saying less stock reserve adjustment, we are reducing it. Correspondingly, where should we reduce it from? Correspondingly, who made profit? Holding company made profit. If holding company made profit, where is holding company's profit reflected? In reserves and surplus. So go to consolidated profit and loss account or consolidated reserves and surplus. Whatever is given in the question. Generally, we would have gone into consolidated P&L. So go to consolidated P&L, reduce the 20 rupees correspondingly from consolidated P&L. This is what you're supposed to do. Right. Now, the other possibility, what can happen is maybe subsidiary sold it to holding company. Subsidiary would have same transaction. It is not holding company selling it to subsidiary. Subsidiary sold it to holding company. Then what is the possibility or what is the treatment? Again, visualize at an overall level. Where will the profit sit? Profit will sit in the balance sheet of subsidiary company. Profit and basically profits, reserves and surplus, all this from the balance sheet of subsidiary. Where will they get discussed? Straight they will go into analysis of profit. Correct or not? So this will go into analysis of profit. In analysis of profit, that 20 rupees should be subtracted from the post acquisition, if it is from the post acquisition period. So it should be subtracted in the analysis of profit when if it is sold by subsidiary to holding company and subsidiary made profit. Correspondingly, where should it be subtracted? From stock, it should be subtracted. Now, Sai, if you are adjusting in the analysis of profit, what is happening? You are adjusting it either from pre-acquisition or post-acquisition based on that profit, whether it belongs to pre-acquisition period or post-acquisition period. And in the analysis of profit, after all the adjustments, the pre-post profits what you have, you will split into what is holding company's share and what is minority interest share. Holding company's share of pre-acquisition profit will go into cost of control. That is your question. Whether it will go into goodwill or calculation. Yes, it will go into goodwill calculation if this kind of thing happens. So when there is a post-acquisition profit and that post-acquisition profit attributable to holding company's share, that will go into goodwill calculation. Goodwill means basically cost of control calculation. It can either be goodwill or capital reserve. It will go into that calculation. So, Sai, I hope it answers your question. Right. So then let me look at the next question. Who is this? Deep Gupta again. So, sir, can you please suggest most likely topic from consolidation? How much I wish I knew that. If only I knew exactly which question from consolidation will appear in examination. I think we will be gods. We will not be human beings. Okay. So please get rid of this. What is more important? What is not important? Kind of thing. See, consolidation is an important topic. But I want to tell you one thing. This is for everybody. Consolidation is very interesting. Consolidation is addictive. You listen to our classes of consolidation, you just fall in love with consolidation, and you will find it extremely, intellectually stimulating. So it's amazing. The point is an examination. How much of an expert you are in consolidation? I have a very strong suggestion for you. You should answer questions of consolidation and amalgamation towards the last part of your examination. You should not start with consolidation. Never in your examination should you start with consolidation. Consolidation should always be attempted towards the end of your examination. I think there is some issue with connectivity. Is it all right? Just a moment, guys. I think there is some issue on connectivity. Please excuse me for a moment. Yeah, I think we are almost there. It's just, yeah, I think we're back. All right. So yeah, so what you should do is you should attempt the questions of consolidation towards the last part of your examination. The reason is, see, it is accounting standards kind of question. I think in my last session of webinar, I shared this point. Accounting standard question, at the moment you read the question, you exactly know whether you know the answer or you don't know the answer. There is no midway about it. If you study it, you know it. If you don't study it, you don't know it. But something like consolidation will have calculations, and there is a good chance that maybe after you start, there is some, maybe even a small mistake in the calculation may possibly happen. I don't want you to get stuck. So that is why please take consolidation questions towards the end of your examination. That is the last half an hour, last half an hour of your examination, and don't make it as a first thing that you attend your examination. So, our friend, I think that is the best advice I can give you. There is nothing called important, not important. And yeah, so then there is another question coming from somebody called Shri. So her question is whether such extra 1 lakh won't be credited to the reserves and surplus of subsidiary. I think this is in relation to Shri. I think about the point in relation to the debentures. Okay, yeah. So if you talk, I'm assuming that that's what you're talking about, because that 1 lakh rupees example we spoke about regarding debentures. That 1 lakh rupees, that debentures. See what has happened. Holding company purchase. It's something like this. It's a liability of 15 lakhs. What we had. That liability of 15 lakhs, to settle it, holding company paid 16 lakhs. Think about it. Who made investment into debentures? Holding company made investment into debentures. So to pay, says you have a creditor. You have to pay 15 lakhs to your creditor. Debentures are the creditors only, So for a creditor to whom you have to pay 15 lakhs, you paid 16 lakhs. Now tell me, is it a good thing or a bad thing in one way? It is an extra burden. Extra burden on whom? It is an extra burden on the holding company. Holding company paid that extra. That extra burden is a loss. That extra burden is whose loss? Holding company's loss. So now, Sri, that answers your question. If that extra burden is a loss, should that be paid? Should that be debited to holding company's P&L, or should it be reduced from analysis of profit? Means what? Should you subtract it from subsidiary company? It is from holding company only, because it is a burden of holding company. It should be reduced from the holding company's position. So you should subtract it from consolidated P&L and reserves. So if you have consolidated P&L, reduce it from consolidated P&L. Otherwise, if everything is put together into consolidated reserves, subtract it from consolidated reserves. I hope it answers your question. Right. Then let us go to the next question. The next question is regarding, so in a question on football limited, hockey limited, multiple acquisitions on different dates, etc. Okay. The answer does not deduct capital profits for finding cost of control. Okay. So see, the logic here is very simple. Whenever you have multiple acquisitions, I'll tell you that one point where most of the students make mistake. Whenever you have multiple acquisitions, the common mistake is, say for example, there was acquisition on 1st of January. Then second acquisition, on 1st of January, we acquired 60% of subsidiary. On say 1st of April, we purchased 20% of subsidiary. So like this, we have done two acquisitions. On the first acquisition, 60%, next acquisition, 20%. Now, when you are doing the accounting for this first acquisition of 60%, forget about any acquisition which happened later. Forget about any acquisition of 20% which happened later. Just view it as if you acquired only that 60%. Do the cost of control calculation only for that. do the calculation of goodwill calculation, all of that. Do the entire calculation only for that. And after you calculate, basically you have to do analysis of profit. That's what I mean. Prepare an analysis of profit. When you prepare analysis of profit, if there are adjustments like goodwill adjustment you have, or something like debentures adjustment you have, or you have dividend adjustment, or abnormal items adjustment, time adjustment, do all those adjustments for that AOP independently. Don't say, oh, later some other acquisition happened. Forget about it. Later the acquisition happened or not is inconsequential. Ignore that. By ignoring that, just talk about this adjustment or this acquisition of 60% which happened, and do the entire AOP, all the adjustments you apply for that particular transaction. After that, complete that adjustment, complete that AOP, then come to the 20% adjustment. When you come to this 20% adjustment, listen carefully. You should not have that 60% in mind. Forget about that 60%. Don't say, oh, I already adjusted it there. Doesn't matter. As if you have not done anything earlier, prepare an analysis of profit and separately do the adjustments. Analysis of profit adjustment, whatever bonus adjustment you are supposed to do, dividend adjustment you are supposed to do, or every adjustment, whatever is applicable. Everything, just carry out those adjustments independently for the second acquisition of 20%, as if that earlier acquisition hasn't happened at all. So then you will get ultimately the position of what should go into pre-acquisition, what should come into post-acquisition, and then what is holding company's share and minority interest share. Now listen carefully, there is an important point here. Holding company's share, in that 60% when you are calculating, you will simply say holding company's share 60%. What is minority interest share? Remember, minority interest share is not calculated on the date of acquisition. Minority interest share should be calculated with reference to the percentage that minority holds in the minority holds in the subsidiary company on the date of consolidation. What do I mean by this? Say for that first acquisition of 60%, I will write holding company 60%. Minority interest, I will not write 40%. Minority interest, I will write 20% only. Why will I write 20%? I will write 20% because minority interest should be calculated with reference to the date of consolidation, not with reference to the date of acquisition. So similarly, when I come to the second acquisition of 20%, I will write holding company acquired 20%. So for 20%, what is the share of pre-acquisition and post-acquisition profits? And after that, minority interest. Minority interest, how much will be calculated? Will you calculate for 80? No, you will not calculate for 80. You will calculate only for 20%. So this is one important point you have to bear in mind. To understand this point in detail, who asked that question? Whoever asked the question, just ensure that you refer to our videos of consolidation. See, consolidation you should never by heart. Consolidation is so logical, you have to just, if you understand the logic, consolidation comes to you, that's all. So you have to focus on understanding the logic. And we made our best effort to help you understand the logic, and you can refer to those videos on consolidation. All right. Then let me look at the next question. It's okay. So there are some generic questions. I don't prefer to answer these kind of questions as to should I start IPCC both groups now or later? Friends, ideally you should have started your preparation yesterday. Okay. It's not about whether you should start it now or not. You should have already started it. And there is no question about when you should start it. But of course, if you are not writing your examination in November, then whatever group you are writing in November, you prepare for that. And as soon as you are done with your exams, you can start preparing for the next group. Okay, so that's a smaller question. So let me see if there are other questions. Okay, yeah. So there is one more question which came here. So Joseph asked a question from Gauhati. It is regarding bills of exchange. So his question regarding bills of exchange is, sir, when do you subtract something from bills payable, bills receivable? Okay, so let me just sip a bit of water and talk to you. Joseph, the point here is, if you talk about bills payable, bills receivable, understand the simple logic. If on the date of consolidation, imagine you are not doing any contra adjustment, subtracting bills receivable, bills payable. You are not doing anything. on the day of consolidation, if you will have bills payable on one side, bills receivable on the other side, if you are expected to have these, then whatever is the amount available, for example, bills receivable is for 1 lakh, bills payable is for 1,20,000. Okay. Now, what is the possibility when bills payable is 1,20,000? How can bills receivable just be 1 lakh? Well, maybe in the bills payable, we have bills which were given to some outside party. Then intercompany between holding subsidiary, the bill is only for 1 lakh. That is one possibility. Okay. So in that case, what should you do? Then 1 lakh rupees is the intercompany balance. Then 1 lakh rupees should be subtracted from the asset side, that is bills receivable. 1 lakh rupees correspondingly should be reduced from the bills payable on the liability side. Okay. Then there can be another possibility. 1,20,000 of bills which are in bills payable are intercompany, means between holding subsidiary only these bills are created. So bills receivable, bills payable. But 1,20,000 of intercompany bills is standing in the bills payable, but on bills receivable side, we have only 1 lakh. Is this possible? Yes, it is possible. How is this possible? When this is 1,20,000, how can this just be 1 lakh? Maybe that 1,20,000 is the bill payable for subsidiary company and it is a bill receivable for holding company. Subsidiary company has in the payables 1,20,000 and holding company has in the receivables 1 lakh rupees. How is it possible? 20,000 rupees maybe holding company gave it away, or it's called endorsement of bill or discounting of bill with bank. So one of the two would have happened, based on which from the holding company the bill would have gone out. So then it is not sitting in the bills receivable of holding company. Already to that extent cash has already come in. That's what I mean by that. So then friends, 1 lakh you have on the asset side, 1,20,000 liability side. We just did in the consolidation contra adjustment. You should subtract 1 lakh rupees from assets, 1 lakh rupees only from liabilities. Remember, 1 lakh rupees from asset, 1 lakh rupees only from liabilities. And that 20,000 rupees, what would have happened? 20,000 rupees, basically holding company discounted with bank or holding company endorsed to someone else. So in such case, that 20,000 rupees will appear in the contingent liabilities of holding company as a note where you will have bills receivable amounting to 20,000 rupees have been discounted and they are pending due date, or bills receivable amounting to 20,000 have been endorsed and they are pending due date. Like this, you will have a note. Now, amounting to 20,000, you have a note like this. Now, my question is 1 lakh rupees we subtracted from assets and liabilities. This 20,000 rupees is also an adjustment that you have to make. This 20,000 rupees, how will we deal with this? This 20,000 rupees you will subtract not from the balance sheet. This 20,000 rupees you will subtract from the contingent liability note. We call it as cancellation of contingent liabilities. Even this point I explained in detail in our videos. So you can refer to our video modules on IndigoLearn platform. So you will have consolidation related learnings, and this point I explained in detail with a lot of examples. Okay. Right, so there is somebody called Gokul Praveen. His question is, sir, explain details regarding subsidiary companies having shares in holding company, its procedures, example, and so on. Okay. Gokul, I think in the interest of time, I have to be brief, but after this, if you still have doubts, so I'm assuming you're in CA final, and if you still have doubts, we can talk about it later. So whenever there are these, we call it as intercompany holding. So holding company has a subsidiary company and subsidiary company has a holding company. Then for this, there is a simple logic that we have to apply. See, if I say, what is holding company's position of profits, or what is its holding company's strength? To that I would say, holding company's strength is its own assets and liabilities plus this much of subsidiary, 80% of subsidiary. Then in this kind of cross-holding, means holding company has shares in subsidiary, subsidiary has shares in holding company. Then subsidiary company will say, yeah, to understand my strength, it is my independent assets plus maybe some 20% of shares of holding company, subsidiaries invested into. So even before the holding subsidiary relationship came into existence, so it will say 20% of holding company's assets are mine. Now that is when holding company says, hey, I said 80% of your strength is mine. You are saying 20% of my strength is yours. So where do you start? You can't start one first, second one later. That is why in our school we learn something called as simultaneous equations. You remember? We learn something called as simultaneous equations. The principles of simultaneous equations you have to apply if there is intercompany holding, and we call it as cross holding actually. So if there is cross holding, you have to apply the principles of simultaneous equations. And by applying the principles of simultaneous equations, you will have to solve this. Gokul, I am not able to solve a full-fledged problem because to solve that problem on simultaneous equation, it can't happen over a discussion like this. It needs to be solved, and look into the problem. If you are not able to understand, please write to IndigoLearn, and we are always there for students, and it will be answered on a priority. Right. So if there are any other questions you ask, otherwise I'm going to the other questions which we have from our other students. Right. So there is one other problem which we got, one of the question we got from Udayini from Bhubaneswar. Udayini's question is, sir, when should you decide to do contra adjustment? When should you decide to remove unrealized profit? So Udayini, actually these are interconnected. Understand carefully. If I say bills receivable, bills payable, it is only contra adjustment. Contra adjustment means it should be removed from assets, it should be removed from liabilities. That is what I mean by contra adjustment. But if holding company sold goods to subsidiary company, we spoke about this some time back also. Holding company sold goods to subsidiary company. Then that amount, say a holding company sold means for holding company there is a receivable. For subsidiary company there is a payable. Receivable means it's sitting in debtors, and for subsidiary company it is sitting in the creditors. Say 1 lakh rupees, or let me simply put it, 100 rupees is the cost to holding company, 20 rupees is the profit. At 120 rupees, holding company sold to subsidiary company. Then, how do you deal with this? There are two dimensions to it, friends. One dimension is simply the contra adjustment. What is the contra adjustment? There is a receivable that holding company has to the extent of 120. And the subsidiary company will have the same 120 rupees as payable. So 120 rupees receivable, 120 rupees payable. These two should be reduced. So reduce 120 here or reduce 120 there. So that way you are basically ensuring that the intercompany balance is eliminated. Wonderful. That is the first part of your question. The second part of your question is, sir, when should you remove this unrealized profit? When should you worry about unrealized profit? You will worry about unrealized profit if one company, like holding company sold to subsidiary or subsidiary sold to holding. In our example, I took holding company sold to subsidiary. Holding company sold to subsidiary at a profit means that profit is sitting in the P&L account of holding company, and that sale happened where the sale happened to whom? To the subsidiary company. So subsidiary company purchased that stock, and most importantly, that stock must still be lying in the closing stock of subsidiary company. Only in such case you have to talk about removing the unrealized profit. Otherwise, you don't have to worry about unrealized profit. If subsidiary company in turn sold off those goods, then there is a question of unrealized profit. It becomes realized profit only. Realized does not mean you got cash. Realized profit means if subsidiary in turn sold off, risk and reward will be transferred. Enough. That means you can recognize that profit. That profit is something which we are entitled to crediting to our P&L account. So you can call it as realized profit, and you can call it as our gain. Right. So if it is unrealized, then you will have to subtract. As I told you some time back in this video, I already discussed that point. You will reduce it from one side, that is stock. Correspondingly, holding company earned a profit. If holding company earned a profit, where should we subtract it from? You should subtract it from holding company's profits. Means from consolidated P&L, you will reduce that. And if subsidiary company made that, then you will reduce it from the analysis of profits. So I hope Udayini, Udayini, I hope your question is answered. All right. So there is one more question that I just got from Jaspreet Singh. So his question is, sir, what shall be treatment of dividend declared on preference shares? Jaspreet, I am 100% sure that you joined the session slightly late because who asked that? Vivek Bhatt from Bangalore asked that question, and you can watch the video in the initial part of the discussion. I actually answered para 27 of Accounting Standard 21, which talks about the treatment for preference share related adjustments. So I answered that. So Jaspreet, you can look into that particular point from the earlier portion of the video that I already explained. Right. Then let me go to the next question which I have. I think that would mostly be the last question for today. That last question is from Sneha. She wrote from San Francisco. That's the power of digital, right? So we have some students. We were lucky in that sense. So we have approximately some 400 students from outside of India who are getting to access our courses today, right? So Sneha's question is, sir, at what stage should we deal with this rectification of errors? So imagine there is a mistake in the balance sheet of subsidiary. What kind of mistake can you talk about? Say, in the balance sheet of subsidiary, the mistake is, let me just take some water and continue. So Sneha, so imagine in the balance sheet of subsidiary, there is a mistake. Like, bonus was issued by subsidiary but not accounted. Bonus issue was done but not accounted. Or maybe a wrong item, something should have been charged off, got wrongly capitalized. So whenever you have any errors, remember rule 1. Before you consolidate, you should remember that you should consolidate correct balance sheets. What is the point in consolidating wrong balance sheets? So if there is any error, what you should do is first thing first, ensure that you are removing or you are doing the required treatments to correct those errors, and then you do the consolidation. So if bonus accounting was not done, now do the bonus accounting for subsidiary. So what will be the treatment or what adjustment assets and liabilities and capital if this adjustment is, if this bonus treatment is given? So yes, reserves will go down and the share capital will increase. All right. So bear that point in mind when you are doing the consolidation. I am not asking you to prepare one more balance sheet after rectifying errors. We will not have time to prepare so many balance sheets. Preparing that one consolidated balance sheet itself is a big deal. And I know that is why so many of you are actually watching this video on YouTube as well as on Facebook. So friends, please understand, you don't have to prepare this updated balance sheet or corrected balance sheet. You just have to have clarity. These are the two items which will change when we rectify the error. And that point you bear in mind and when you do the consolidation. So what I mean by that is, if reserves should come down, then make sure that when you are making AOP, that reduction to the reserves you are giving effect in the analysis of profit. When I say AOP, I'm talking about analysis of profit. So give effect to that in the analysis of profit. Similarly, when I talk about share capital increasing, when you are doing the cost of control calculation, give effect to it. That's all. So if any capital item, revenue item, capital item was wrongly charged off, etc., capital expenditure wrongly charged off, correct it before you start the consolidation adjustments. All right. So I think there are a few more questions coming in. So, but in the interest of time, so I want to stop the session here. I hope you enjoyed it. I look forward with my team IndigoLearn for your feedback on how we can improve your learning experience. We are not just a video selling company. We are a company which cares for students. We are an institution which loves to see you succeed in your examinations as well as in your real life. So please reach out to us if you have any doubts regarding consolidation or any other topic, and our team is always at your service. And if any of your friends, for any reasons, haven't been a part of this session, we discussed close to 12-13 very interesting cases in consolidation. I'm sure this would be a doubt for some of your other friends as well. So please share it with your other friends so that they can get benefited. And in the next week, same time, I plan to do amalgamation related discussion. So as you saw, we got questions from Ahmedabad, Ujjain, Bangalore, Vijayawada, San Francisco, Bhubaneswar, Guwahati, Kashmir. I don't know some of our friends, Jaspreet, Sri, then Deep Gupta, from where they posted those questions. But we got questions from different parts of the country and world. So Please post your questions in advance so that we can prioritize your questions. I know that some of you might be upset that your questions haven't been taken up, but don't worry, please post to us and our team will ensure that we are responding to you. Right? Thank you very much and enjoy your learning. Good luck.